Hi, and welcome to another edition of Danny Brown Talks Phoenix. I am your host, Danny Brown, and this is our April market update, April market update. We're in May. Sorry, I'm just getting back from vacation, so still trying to get back into the groove. But as always, I am joined by Garrett Sirkvenik from JFQ Lending. How you doing, Garrett?
Doing well. How about yourself?
Doing very well.
Great.
Thank you. Yeah. So why don't you tell us a little bit about what's going on in the mortgage world right now?
Okay. Mortgages, we've stayed a little bit flat over the last few months. We saw rates start to come down in December of last year, and they've kind of ebbed and flowed a little bit.
Sure.
But from this time last month, they're about the same. They've actually, average rates have come down a little bit. And it's kind of been interesting because especially over the last week, different lenders have reacted differently to what's been happening in the news. Mm-hmm. Some lenders have repriced a little bit higher, some a little bit lower, but for the most part, not a huge move in the market. Rates are very, very low. We're still at a 14-month low. We haven't seen rates like this since, the beginning of 2018.
Okay.
So it's a great time to refi. It's a great time to purchase. People have a lot of buying power, because, rates are at a low point. So I think there might be some movement coming up in the market. Obviously the current administration is working on some tariffs with China. So I think those were announced today, but we really didn't see the market react like we thought. The stock market.
The stock market's definitely gone down.
Yeah, it's gone down. Not plummeted, but it's gone down. But it really didn't have an impact on mortgage rates like I thought it would.
Right.
So they've remained flat. And, maybe we'll see some action next week, where they'll tumble a little bit. But
I've heard that if the market does go down, if the global economy the growth starts to slow, that we could actually see mortgage rates go down as a product of the tariffs. Is that?
Yes.
Okay.
We can see them go down. There's a lot of things that impact mortgage rates, and none of them impact it directly. But people, as things happen in the global market, people shift their money, and sometimes they put them into mortgage-backed securities, and so that has an influence on where rates are at.
Sure.
Bottom line, good time to refi, good time to purchase. Good time to reach out.
I feel like we say that every month.
Yes. Well, I think when we were doing this last year, I was saying, hey, it's a good time to buy or to purchase because or to refi because rates are going up, and we're expecting them to continue to climb.
And they did.
And they did.
Yep.
Get in while you can.
Yes.
Now it's the opposite. Take a look at it, and let's see if we can save you some money on your current mortgage, or if you can buy something new. I think you should reevaluate your mortgage every few months. If you work with a lender like me, or a good lender, whoever it is, they will be reevaluating your mortgage for you. Mm-hmm. Typically, so there's what's called a recast period with a mortgage. So if you have a broker that does your loan, if you were to refinance or sell that property, usually within the first 6 months, they get charged back whatever commission they made on that mortgage. So, So that's why a lot of them will say you have to be in this mortgage for 6 months. You don't have to be, but they'd like you to be. It's if you're working with somebody that you trust, stay in your mortgage for 6 months. Don't, because they're going to lose all their money they made on it.
Right.
But after that, I would say take a look at a refinance every 6 months. See if there's something out there. There's a lot of people that don't believe in essentially churning mortgages, but we have clients that will refinance for 0.25% because we can do it for free. Mm-hmm. We can either save them a few bucks on their mortgage payment, or we can cut a year off of their mortgage and keep their payment the same. So if you're not paying cost, any drop in interest rate is going to be a step in the right direction.
Absolutely.
And in the process, you get to skip a payment, you get a refund from your escrow, so you can put a couple $1,000 back in your pocket. Use that to pay off some other debt. So I think there's always a time to look at a refi, and if you're working with somebody good, they're going to tell you when it's not the right time and to stay put. Mm-hmm. But if there's a product out there that makes sense, they're going to advise you that as well.
Very nice. So I actually just today had a friend reach out to me about asking me what I knew about refis, and I got to talking with him, and the reason that he asked is he saw an ad on Instagram, and for whatever reason he clicked on it, and it turns out it took him to a link to Quicken Loans, and
As most links do.
Yeah,
They buy everything.
and they told him that he could save $400 on his payments without him giving them really any information. Could you used to work at Quicken, and so I'm just wondering how an institution like that, without knowing my friend's situation, could tell him that he could drop his payment by $400.
Got it. So yes, I worked there for almost 9 years. A big chunk of my life. Those ads are designed to drive a phone call or to drive a click in this case.
Sure.
Click on this, fill out your info, let us call you so we can talk to you about a mortgage. What they're doing is they're taking, his mortgage is recorded publicly, so they can pull what his original loan amount was, figure out what his principal and interest payment is currently, and then they're going to quote something based on a new payment, first of all, that's just principal and interest. So he's going to see, maybe his current, payment includes his taxes and insurance, and it's $2,000 a month, but his principal and interest portion of his payment is $1,700, let's say. They may only be able to save him $20 off of his mortgage payment, but when they send him a flyer that says, "Oh, we can take your payment down to $1,680 from $2,000," they're not telling you that, well, this doesn't have your taxes and insurance included. So that's part of it. Yeah, it's designed to drive a phone call, because then what they do is they get you on the phone and they say, "Oh, well, we can only save you $20 here, but maybe if you spend $10,000 in closing costs, you can get this rate, and then we'll save you $150 a month, and over the life of the loan, that'll save you money." Well, the average person stays in their mortgage for 3 to 5 years, so it doesn't make sense because you don't recoup those costs.
Sure.
Most of those ads are just to drive traffic, and you should ignore them. Or better yet, if something sparks your interest, if you see something that says, "Hey, I could save some money right now," call your mortgage guy that you trust, and have them take a look at it for you. If there's not something out there that makes sense, they're going to tell you that. If there is a better option out there, they're going to tell you that.
Sure.
So I think that when you're dealing with these big retail banks and with a lot of advertising, unfortunately, in the industry, you're going to get a lot of stuff that is not. It's a little deceiving.
Sure.
And you really have to be wary of that.
Yeah, and most of these companies, they get paid based on applications, not based on if you actually close. So,
well, the company gets paid on the loan closing.
Sure.
But your loan officer that you talk to, with Quicken, for instance, they're paying people to just set up the loan. They've got very little skin in the game. They're not analyzing your overall scenario. They are trying to get a loan in the door, and so they can make their $150 or $300, whatever it is. So, really be wary of stuff like that.
Sure.
Because if they're deceiving you to get a phone call up front, probably, there's going to be some more of that going on in the process.
Sure. And the old adage is probably true. If it seems too good to be true, it probably is.
Probably is.
Yeah.
But
it's still worth exploring.
If you talk to somebody you trust, maybe it's not.
Yeah.
Maybe you're at an 8% interest rate, and we could take you down to a 4.5%, and that
God,
will
I hope
save
nobody's
you
at
4.5%. I know.
8%.
I don't think anybody is. Well, some people are, but
Unless you're hard money.
Exactly.
Yeah.
So, I would just be wary.
Nice. Well, to give you kind of an update on where the real estate market is, right now in Arizona, or Maricopa County rather, we have 17,500 listings active on the market. This time last year, we had just over 16,000, so that's up over 7%. But we're actually down from last month. Last month, we had 18,600 listings. So we're down 6% from this time last month.
Okay.
So active listings are down. That's good for sellers. So inventory is low. Pending listings, right now we're at 12,400 versus 12,500 last year. So fairly similar.
Real quick, now I keep hearing that we're slowly shifting from a seller's market to a buyer's market, or at least becoming more of a balanced market. Now, if there's more inventory out there,
there's less inventory.
Less inventory out there, then wouldn't that show that you're still in a seller's market? Or
the real estate market is like any market and changes very rapidly from time to time. So, when we were talking and doing the same exact podcast a couple months ago, when rates were going up and the market was really slowing down, it pointed towards, yes, the market was shifting from the seller's market towards a more balanced market. And now that rates have flattened and have been flat, we have seen the busiest April that we have seen since 2004, I think.
Wow.
And I can attest that in my own company. We just finished, April was our best month we've ever had as a company. So, hopefully that's a mixture of things that we've been doing to help our clients and get business in the door, but also a product of the real estate market.
Yeah.
So yes, we were shifting and things were swaying back towards buyers, but the pendulum's gone the other way.
Okay.
It stopped and it's now, firmly back in a seller's market. Now, we're talking about the market in generalities. There's different price points. And so when you start getting up into the luxury market and the semi-luxury market, that's absolutely a buyer's market. Those properties tend to take a lot longer to sell. So, I'm talking about the market as a whole. Your specific situation, depending on where you're, the value or the price point of your home, it's going to impact.
It can differ.
Yeah. So your market could be definitely different than what I'm talking about as the market as a whole.
Gotcha.
There's nothing at sub 200,000. The entry level price point for homes is much higher. I mean, right now,
I think the average in Maricopa is like 285,000 right now, or something like that.
Yeah, well, close. The average sales price right now is 270,000 versus 255,000 last year.
Wow.
So affordability has been greatly impacted. So rates are higher than they were this time last year, right?
This time last year, no, but yes, it was the tail end of rates being really, really low.
Okay.
So I think when people were selling at this time last year, they had locked in 30 to 60 days before that when rates were lower.
Okay. Well, my point being is that with the average sales price being higher than it was last year, with interest rates being higher than they have been, affordability has been greatly impacted. So that entry level home or first time home buyers are needing to save a lot more than they did before in order to buy, to have money for a down payment, to have the money for the closing costs and all those types of things that go into it. And the average sales price per square foot right now is $171.80 versus $162.84 last year. So that's up almost 6%. So that's a big jump year over year. And so, the real estate market here in Phoenix, it's strong. The Phoenix economy is really strong. So I wanted to read, I found this statistic that real GDP, gross domestic product, increased in 49 states and the District of Columbia in 2018. I'd hate to be that 50th state. And Arizona ranked 4th in terms of statewide real GDP growth in 2018. So this is just evidence of how well our state is doing economically comparatively to other states. I think, coming out of the recession, the people, I don't know who these people are, but people who are running, our economy and running Arizona realize that we cannot put all of our eggs in the construction and, housing and growth basket, that we need to diversify a little bit. And I think over the last 10 plus years, they've really done a good job of diversifying the industries that are in Phoenix and our economy so that we're not so based on just, housing growth and construction. I want to point out that, I had a lot of clients and a lot of buyers who were talking about how they were going to wait because they thought prices were going to fall. That they've definitely been left behind. So with home values and home prices where they've been and where I think they're going to continue to go, housing's just going to get more expensive.
Yeah.
We talked a little bit about the tariffs and how that was impacting the economy as a whole and how that could kind of impact rates. I wanted to touch on that employment right now is growing at twice the rate necessary to keep pace with growth in the working age population. This is, as a result, will pull more unemployment workers into the labor force. In addition, employment has also grew well above expectations, and unemployment rates are at a 50-year low for the economy as a whole. And I've actually seen ads that, what's the company when you're 55? AARP.
AARP, yeah.
AARP is now publishing employment ads for McDonald's because McDonald's has a shortage of labor.
Really?
And they are looking at recruiting retirees to come and work at McDonald's. Huh. So we have a huge shortage of qualified workers in this country, and it's also impacting the construction and labor markets. We have a shortage of electricians, of carpenters, of plumbers, all of these things, and it's delaying, it's holding back our growth. So a lot of economists are talking about how we're coming up on the 10th birthday of this bull market that we've been on, and when is the end has to be close. And I would argue that our growth probably could be a lot faster than it has been. And so the end may not necessarily be near, because we do have this shortage of qualified workers that's stalling growth. The tariffs and the trade talks with China is also going to stall growth. So, maybe the economy could have been growing faster over the last 10 years and hasn't, because of these other effects have kept the growth slow.
Got it.
I mean, I'm not an economist. I'm just kind of
Just
speculating.
Yeah.
So, I don't know if that holds true, but the fact of the matter remains that all indicators are pointing that the economy is super strong right now. Wages are increasing faster than inflation. Wages are increasing faster than property appreciation as well. So that's a really good sign for the housing market. That's a good sign for the economy, as long as that continues. And again, correct me if I'm wrong, but I don't think the Fed is going to raise rates or touch rates probably the rest of 2019.
I don't think they are either. I mean, there's been oddly enough, the thought last year was that they were going to continue to climb, that we're going to have all these rate increases this year, and we're just not. I mean, I think they went up a little bit too quickly. We had 3 rate increases very, very fast. One a quarter, and I think that was a little too fast. So they put
love him or hate him. Trump got that right.
Yeah.
Told the Fed, what the hell are you doing? Stop raising rates. And whether or not they were going to do it anyway could be argued, but they stopped raising rates, and it's really improved everything. And the talk of recession and all of that has kind of gone out the window.
Yep.
So, all indicators, I guess we both echo the same thing. All indicators just keep pointing towards a strong economy, strong housing market, and hopefully everyone out there is feeling it and noticing it. So I hope your wages are going up and home values are going up, and you're enjoying this as like everybody else.
Yeah.
So any closing thoughts on where we are in the marketplace?
I don't think so. One thing just real quick to touch on, I know we're almost out of time. You had mentioned, affordability, home values continuing to climb, and it's becoming, people waiting for home values to go down, and now they're kind of shopping themselves out of the market because they're having to put a bigger down payment down. There are a lot of programs out there that have come up about in the last couple of years that really help for down payment assistance and things like that. One of the programs that a lot of retail banks, like your Quickens, your Wells Fargo's, your B of A's, U.S. Bank, offer down payment assistance, and it's they can give you up to 5% for a down payment. The challenge with those is they put a lien on your title. And so when if you were to sell in the first 5 years, if you try to refinance, sometimes that's prohibitive. It limits you a lot. We have a program on the broker side, and it's only offered to brokers, where we can do as little as 1.5% down on an FHA program. And then you can get sellers' concessions to cover your costs. So you can really get into a property. Let's say you're buying a $270,000 property, just the average, you're spending $4,000, for a down payment, and that gets you in the home, and that's total. Costs are covered by the seller. You can, arrange that. 2% gifted from the lender. There's no lien put on your title, so the rate may be a little bit higher up front, but you can do a refi 6 months later and get down to where the normal market is.
Wow.
And not have to worry about a secondary lien that may be paid back if you sell or if you refi or anything like that. And and you can get into this property for 1.5% of the purchase price. So there's some really cool options out there, for folks, because down payment is usually the thing that's the hardest.
For sure.
People can get their credit up. They've got the income to make it work, but saving that money and putting, say 3.5% down on a $200,000 home is $7,000 plus your costs. So, if you can do that same property for, $3,500 or $3,000, it just makes it a lot easier. So.
Yeah. And I think it's important to point out that, people should also buy within their means.
Yes.
I've noticed a lot of buyers right now being incredibly responsible. every time I have a conversation with a buyer, they know exactly where they want their payment to be, and it seems to be drastically lower than what they could actually afford, and they're fine with that.
Yeah.
And they don't want to be house rich and money poor. They still want to be able to do stuff, enjoy their life, and have, you know, a fairly decent home. And so I think that, you know, we're getting a second chance at all of this since the recession, and people are being extremely, for the most part, very responsible with how they're purchasing their homes.
Yeah.
And I've seen a huge increase, at least in our business, and it's something that we focus on, and one of our niche is helping people sell in order to buy. So I'm noticing a lot of people who have purchased over the last 10 years, which is how long I've been in real estate, so it makes sense, are selling their, you know, their first or their second house and leveraging that to buy their next one. And it's a very complicated and stressful transaction, as a lot of my clients, and including you,
I'm currently in that process right now.
So it's really important, I think, to work with someone or a team that has experience in that, because it is very challenging to navigate those waters, and there's a lot of nuance to making sure that that goes smoothly, and it can. I think it's the most stressful thing that someone can take on in real estate, and maybe even in their life, to move from one house to the next without having to have some sort of stopgap or rental property or something in between. And it can cost you a lot of money. So it's super important to whoever you're working with, make sure that they know how to navigate that and navigate it creatively, because there are solutions to get you through that, to solve things, especially when it's a seller's market. Something that we're doing right now and have been relatively successful at is every single counter that we do when we get an offer with someone who's looking to sell in order to buy, is we just immediately counter with a 7-day post-possession. We counter with a 7-day post-possession. We counter to our preferred title company, because we try to keep everything housed at the same place. And that 7-day post-possession allows you to close on one property, then you can close on the next, and then you've got a week's time to move. You know, closing both properties on the same day is not hard. The hard part is moving from one property to the next. And you know, most people are good people, and they want to leave the property, their home, in clean condition for the next person. And it's so hard to do if you're trying to close on both properties that same day. So there's a lot you can do to try and remove some of that stress and make it a little bit smoother of a process. So just thought I'd add that.
Great.
Yeah. So thanks. This has been another edition of Danny Brown Talks Phoenix, and we will see you guys next month.